This is a preview for the non-farm payrolls released on March 10th. It's the report for February. And we want to see wages. Show me the money. We already had things coming into the event. Some say this is a non-event because Janet Yellen and all the other Fed members basically told us a rate hike is coming. So why do we need the NFP? I don't think it's a non-event. I think it still has implications, but the bar is quite low. Wages and wages matter, okay? What happens in the US economy? The US economy, according to the Fed, is getting closer to full employment. Of course, one may argue that too many people are not even looking for a job, well, the economy doesn't feel so good. Of course, Donald Trump was elected. And, well, in any case, at full employment, if we get there, we're not there yet, but we're very close, according to the Fed. At full employment, there is a shortage of employees. So if employers find it hard to find people, they raise salaries to tempt employees to join, okay? So higher salaries should push inflation higher, core inflation, not only oil prices, not only other volatile figures, and this will get the Fed closer. The Fed targets core inflation. And indeed, we've seen an improvement in wages, very, very gradual. But in December, the report released in January, we've seen not only gradual improvement, but a jump, okay? 2.9%, much stronger than around 2%. But back, in the previous report, we saw a downgrade for December back to 2.7 and January 2.5. Nevertheless, 2.5 is still above the average of around 2 that we've seen beforehand, okay? Now, as we know, as we've talked so many times, the bar is very low because the Federal Reserve is about to raise rates. So I would say that 2.3% in year-over-year wages or lower could cast doubts about the Fed raising rates. Okay, that means we would need to see another big fall in wage growth this time. That means month over month, we will see a fall in February, okay? I would say that's unlikely, but we would need that or even lower to cast doubts that the Fed will really raise rates. We are more likely to see, according to market expectations, a solid 2.8. So after we had a strong figure in December, lower figure in January, we'll see a bounce back in February, and now we'll see year-over-year 2.8. Something I've been thinking about and also written about on Forex Crunch, does the Fed already have the data? Okay, the Federal Reserve, remember this is the NFP released in the second week of March. It's released so late because, well, February is a short month, but the Fed always gets the data in advance. Did they have the data already last week? I'm not sure, maybe. At least now they probably have the data before we do, 2 days before that. So I'm assuming that the Fed already knows that the wage report is not a disaster. Otherwise, they wouldn't have come out with all these statements. Okay, so maybe it's not 2.8, maybe it's lower, but it's good enough. The bar is low anyway. Okay, it's non-farm payrolls, so let's talk about payrolls. Let's talk about the amount of jobs. Expectations stand on basically more of the same, around the average. 185 last time, we had 227. No change expected in expectations. The ISM figures are already out. We do have the ADP today, but it shouldn't make a big difference in expectations. The unemployment rate is important for politics, but not for markets. It's around 4.8, and it changes according to the participation rate, which has been rising. It's a good thing. More people that were discouraged to look for a job are back in the labor force. And U6, what's called the real unemployment rate, is on the rise once again. The trend is lower, but it's a bit rocky. I think the last figure was 9.4%. It matters more in the long term. NFP scenarios, I would say between 2.4 and 2.8, basically within recent ranges. As expected, it's cementing the March rate hike, and markets will continue with forecasting 3 hikes in 2017. In this scenario, I would see the dollar wobble, jump a bit up, jump a bit down, basically cementing the rate hike, which is already priced in. So, of course, we'll have action in markets, but nothing extraordinary. If we have 2.9% or even higher, the magic 3%, I would expect a stronger dollar, not only short-lived, but a more sustained rally in the US dollar, and some speculation about 4 rate hikes this year, maybe March, June, September, and December. If we have 2.3% or lower, we'll have a doubt about this rate hike in a week from now, and the dollar would fall. I would say this is highly unlikely, mostly, well, because the trend has been steady, stable, positive, and maybe the Fed already has the data. Okay, so these are the scenarios for the NFP. Before we move to our currency of the week, pound dollar, a few comments here. Jim, good morning. I think market reaction is not so clear. Let's remember March 2016. Oh, you're talking about the ECB. March 2016, when Draghi expanded QE purchases by a third and pushed rates lower. Nevertheless, euro rallied. Yes, that's a good example when Draghi's magic did not work, when he wasn't Super Mario. Okay, that was indeed quite disappointing for Draghi. Also, in the meeting beforehand, in December 2015, they announced quite a bit and it failed. Okay, but since then, I think he regained his magic in pushing the euro lower. I think he's learned his lesson. What he said back in March 2016, a year ago, was, well, he did quite a lot, but what he said also is that we're done for now, and that's what triggered the counter reaction and the stronger euro. So this time, you say, I think a lack of action, no tapering expansion may push the euro to the upside. I don't think so, because nobody expects at this point the ECB to announce anything new. So it depends more on forecasts and on the tone. Okay, I hope this answers the question. It says, why NFP so late? Well, I think because it would have been otherwise published on March 3rd, early in the month and after a short month of February. I didn't check it in depth, but that makes sense to be the reason. Another question from JM. How do you see the euro midterm, let's say June, July? See it closer to parity or back near 110? I see it closer to 110, assuming that we have a French president who is not Marine Le Pen. Okay, then we could see, that uncertainty will be over. We'll begin hearing talk that 2016 was peak populism, and Donald Trump also, I believe, will not provide the stimulus, not push, that it will be lower expectations from the US economy in general, so I see euro dollar as rising. Parity is hard to achieve. Well, I cannot rule out anything, but assuming we don't have President Le Pen, I think euro dollar will be closer to 110. If Le Pen is elected, all bets are off, okay? I hope this answers the question.